Of the hardest hit bubble markets in the nation, Phoenix is emerging as the first to show significant progress in recovery. But most of that progress is coming on one side of the metro. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Phoenix update. Well, this may be somewhat of a surprise. We actually have positive news to deliver about Phoenix in this stage of the recovery process. But before we get too excited, there's still a lot of lost ground to make up in Phoenix from all of the revenue losses that they saw during the 2008 and 2009 period. But at least things move in the right direction. Let's start with apartment demand numbers. You see that in the past 2 quarters, while most of the country has seen apartment demand really cool off a bit, Phoenix is continuing to record solid gains. Another 2,120 units absorbed in first quarter 2011, and that brings the 6-month total to about 4,600 units. So Phoenix not only renewed the large number of new leases signed in early 2010, but unlike most parts of the country, they also recorded some nice net gains on top of that. And so as a result, we've seen some progress in overall occupancy. Occupancy improved 0.7 points on a quarterly basis, and it is up 2.3 points annually. But the overall rate is still pretty terrible, 90.8%. And rents are climbing as well. Same-store rents climbed 1.6% in first quarter and 3.6% year over year. Despite having one of the nation's weakest occupancy rates, Phoenix actually surpassed the national norm for rent growth in the year ending March. The national norm was 3.3%. So strong revenue growth numbers for Phoenix, but like we alluded to earlier, the overall results have been lopsided in favor of submarkets on the east side of Phoenix. Let's take a look here at this chart showing occupancy rates and annual rent change in submarkets on the east side of Phoenix. You see North Scottsdale topping the list with an occupancy rate of 95.5%, and every other submarket with the exception of Mesa has an occupancy rate of 94%, and solid rent growth in most of these places as well, led by around 8% annual rent growth in North Scottsdale and Chandler, South Phoenix. Now let's take a look at Phoenix's central and western submarkets. The story is not nearly as good. Overall occupancy rates range from 85.1% in the South Glendale, South Peoria area up to just 91.2% in the Sun City, North Glendale, North Peoria area. But we are seeing some momentum on rents. Most of these submarkets did record some rent improvement in the year ending March, with the exception of South Glendale, South Peoria, where rents fell another 1.4% annually. Going forward for this metro as a whole, it's going to take sustained job growth for this apartment sector to continue to recover, especially in those central and western submarkets. Phoenix is a market that saw a big downward revision in its employment change numbers for 2010 when the Bureau of Labor Statistics released its revised data last month. So it's going to take some continued job growth. Phoenix gained about 12,000 jobs in the year ending February 2011, and how the sector does going forward will depend on further job growth. That wraps us up for Phoenix. Until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thanks for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.